Have you ever been to the supermarket and wondered, why is this cereal box $6? Why is this ice cream $7? In this video, I'm going to break down market pricing, supply and demand, and really the understanding of how prices in a market are determined. It's not random science, it's basically the forces of supply and demand, and basically sellers and buyers interacting to determine a market price. Hi, my name is Andrew, and welcome to this podcast called Andrew Talks Business, where I break down basic business and fundamentals in kind of a more conversational manner. Today, we're breaking down a pretty simple idea. It's basically how buyers and sellers interact in a marketplace to determine how prices are determined. It's the foundation of every business study. It's literally supply and demand, one of the first lessons you'll learn in any economics class. From small pop ups to large brands, it's how they determine what they charge for their products or services. So let's get into it. So before we talk about prices, we need to have a fundamental understanding of markets, and this is where the magic happens. So a market is kind of like a physical place or a virtual place. It's any interaction of buyers and sellers because as we talked about in the previous video, buyers want to buy things. They have needs, wants, and frustrations. And sellers want to be able to provide the products or services needed to fulfill that need. Now, the interaction between buyers and sellers is where the magic happens. Marketplaces can be anything. It can be physical or virtual. It can be like Amazon, Facebook Marketplace, clothing stores. It can be your stock exchange, or even like a lemonade stand in a park. The idea here is that there's this facilitation and exchange of needs and wants. It doesn't matter if it's local, national, international. The idea here is that if people are buying and selling things, it's a market. Now, let me explain this idea of a voluntary exchange. Now, in the first economics lessons, one of the first economics lessons I teach, it's this idea of a person named Adam Smith. In 1776, he coined a term, the invisible hand, that in a market, the interactions between buyers and sellers and competition is where you'll find this market price because you have all of these different sellers and they want to make money. The way they make money is that they sell a product at a value price where consumers think it's a good price and where they can make money. As I mentioned in my pizza example, the cost of the pizza is $2 and the market price is $5. Each slice of pizza, the $3 profit generates value for the business. So the business benefits and the consumers benefit. If you think about it, the interaction makes everybody better off because I'm going to value that pizza at a higher price relative to the $5 market price. So the consumers benefit and the businesses benefit. In both cases, the voluntary exchange creates value. And it's kind of the economic and business engine that keeps the economy going. If sellers can't make any money, they'd stop selling. And if buyers can't get any value, they would stop buying. Markets only work because both sides benefit. Adam Smith's idea was that if you let the businesses work out in the economy, they will determine the market price because they want to be able to make money and they want to make sure that the revenue that they generate is what's going to be maximum. They want to ensure that in spite of all this competition, they're going to set a market price that's beneficial for them. Let's say, for example, the market price is $5 for a slice of pizza and they charge $8. They're going to see that a lot of the competition is going to undercut them and that all of their business is going to go elsewhere. So they're going to compete on things like price, quality. They're going to figure out the best way to get people to come into their store. And that's their incentive. So consumers now have choices. They can determine where they want to go to get that $5 slice of pizza. Where is it that they're going to get the best value, the best quality? And all of a sudden, the competition in the marketplace drives quality, choices, and makes things better off for the consumer. So the idea here is that consumers want value, and in this competitive marketplace where there's multiple companies selling pizza, now they have choices. So for example, I can choose between Pizza Hut, Domino's, I can choose between Fresh Slice and other places, and each company is going to provide their perception of value, and consumers now can decide, oh, which is the place that's going to get me the best value, the best bang for my buck. So the idea here is that voluntary exchange, it makes things better off because these pizza places are not going to charge $10, $20 for a slice of pizza. They're going to work out what they think is the best in terms of driving the most revenue, the most sales, the most profits. So they're going to find their way. There's going to be downward pressure on the prices. And consumers, they don't want to spend a lot of money. They want to make sure that the money that they allocate makes them better off. So they're not going to spend $8 for a slice of pizza. So voluntary exchange exists because buyers and sellers are going to trade with each other because they're each getting value. Because there's competition in the marketplace, this is going to drive prices down, and consumers now have choices. They're going to pick the best possible choice that's going to make them the most happy. It's this idea of push and pull which drives market pricing. So let's say, for example, you have the $6 cereal box. There's many different types of cereal brands. They all compete on things like branding, the toys that they offer within the kids' cereal boxes, the nutrients. So there's a lot of different ways that they can compete. So for that $6 cereal box, the $6 was determined between the interactions between sellers and buyers. Sellers want higher prices. They don't want to invest all of that time, money, and energy and resources for them to sell a cereal box for $1. They would lose money. Every cereal box that they make, they would lose more and more money. Buyers want lower prices, but there has to be some sort of compromise. So supply and demand works when buyers or sellers are able to interact and determine an agreeable price. So let's start with this example. You go to the night market, and in this night market, there's a lot of different places selling snacks. Let's say you are selling, cookies. You decide to make cookies for the night market, and you decide to charge $25 for a bag of cookies because, you invest a lot of time, money, and energy into making cookies. But the problem is, are people willing to pay that much for a bag of cookies? Probably not. There's a downward pressure on prices. And if you decide to charge that price, you're going to have all of these cookies. You baked all of these cookies, and nobody wants to buy them. So, what are you going to do to get rid of them? Because cookies are going to go stale. You're going to lower your prices. So, with all of this surplus, you're going to find ways to lower your price in order to get customers to say, hey, I think this is a good price to buy. Now, what happens if you decide to bake cookies and you sell a bag for like 50 cents? Everybody's going to buy cookies. You're going to run out. But then all of a sudden, the money you get is not worth the investment of all of the rent for the booth, the supplies, the time that you invested. So it's not worth it on your end. So that's why supply and demand is often touted as an economically efficient way of determining market prices. It's somewhere in the middle. It's not too high where nobody wants to buy it, and it's not too low where you're not getting the money back for your investment. This is the heart of every price negotiation in the economy. Supply, which is the suppliers, and demand, which is the buyers and consumers. And this interaction occurs like billions of times a day. It's why shirts are sold for a certain price, pants are sold for a certain price, refrigerators, the housing market, gas prices. All of these are a function of supply and demand in the marketplace. Gas is a great example of supply and demand. When there's huge demand for gas, let's say in the summer, and everybody wants to go on road trips, gas prices tend to be higher. When there's low demand, when people don't want to go out, let's say, for example, in the COVID-19 pandemic, gas prices were at an all-time low because nobody was going out. There was low demand for, road trips. So gas prices went down as a function. So if you think about it, there's many different factors that determine price. Supply and demand is obviously a very simplified example, but it's this idea of interactions. What do you think consumers are willing to pay for a product versus what you need to sell in order to make sure that it's a worthwhile investment as a business? So the next time you go to the supermarket, think about the prices of products in various different aisles. Why is milk a certain price? Why do we have that egg crisis where all of a sudden the price of eggs went up? All of this is a function of supply and demand and marketplace exchanges. Egg prices went up because there was a avian influenza, which affected a lot of bird farms, and all of a sudden the supply of the eggs went down. Demand for the eggs, which is from the consumer, remained the same, and in some instances went up because eggs is a product that has a stable demand and in times of recession is a great source of protein. Demand for eggs was stable or even went up, supply went down, so there was an upward pressure on prices. There was even egg shortages, so people were willing to pay more for eggs because that was the market price. There was so much upward price on eggs because there was a shortage. So as you can see, competition really sets a market price. If the seller sets their price too high, buyers go somewhere else. If the buyer insists on paying too little, sellers sell to someone else. It's like in the used car market. Let's say you have a nice car that you've driven for a while, but you want to sell so you can upgrade. So you sell your car for maybe $15,000. So when you sell your car for $15,000, you kind of look at other prices, in the marketplace to make sure that your car price is not too high and not too low. If your car price is too high, people will go elsewhere. That's the beauty of a competitive market. The prices are not determined by random. It's not like you went to like a calculator and randomly typed a number. It's what customers feel is a good price given, the marketplace factors. Through millions of tiny decisions, the market will find a price that buyers are willing to pay and sellers are willing to accept. If you have a nice car and a person was willing to lowball you for like $1,000, of course you're going to sell to someone else. That buyer is going to have to increase their offer when looking at a different car. So this market price is also called the equilibrium price. I teach in my economics classes that if you plot a supply and demand graph, it's kind of like this X. X marks a spot. The intersection is the market price because it's where sellers are like, okay, I can sell it at this price. I make profits. You know, I generate value from my resources. And the buyers are willing to go, okay, this is a price where it's not too high and I still get value because I'd be willing to pay more than $5 for a slice of pizza, and $5 is a market price. I'll buy two slices. Competition is where prices really go to the middle because if you have a lot of different coffee shops on one street and one was willing to sell at $20, but everybody else was more like $5 or $6 a latte, that $20 is going to have to go down because of the competitive factors. Consumers are not going to go to the $20 when they can get similar value at a $5 or $6 coffee shop, which is why Starbucks, you know, they used to be a dominant coffee chain, but all of a sudden more competitors enter the market. They increased their price too much. Now customers are really rethinking their Starbucks purchases. Prices in competitive markets aren't really chosen. Starbucks can't really say, I'm going to sell a coffee for $10. $10 is the coffee. It's the product of the interactions between competitors, competition, which is the sellers, and buyers. That's the beauty of the free market and the interactions in the marketplace. But the simplified version is this: sellers and buyers interact in a marketplace and they determine an agreeable price. If the price is too low, there's going to be too much upward pressure, so the prices will go up. A common example is, you look at things like Pokemon cards. There's all of this demand for Pokemon cards. The free market will say, oh, the prices of the Pokemon cards is now this price for a Charizard. If there's too much supply, then they have to lower their prices. So, for example, fidget spinners was a product that is it quickly became obsolete. I don't see anybody with fidget spinners in the classroom. So there was too much supply. The consumers felt that it was too expensive, so all of these companies had to lower their price to some sort of equilibrium market price. And if you look at the stock market, you'll realize that through these interactions, the market will determine the appropriate price for things like the price of the company, for a stock. It could even be the price of oil. So things are constantly changing every day. So through this interaction of buyers and sellers, the market will set a price for a product or a service. And this is how stock markets work, how grocery stores price food, airlines price their flights, clothing brands price their shirts, and how tech companies price their subscriptions. Because Netflix, all of a sudden, they have all of this good content. They're maybe buying Warner Brothers. Eventually, they're going to work their price up and increase prices to adjust for the cost of their acquisitions. If everybody was suddenly flying to Cancun, the demand for prices would increase the price of tickets, and all of a sudden, you're looking at double, triple the prices for certain days. Why do you think airlines specifically charge higher prices around the holiday season? There's all of this demand and upward pressure on prices. So they didn't all of a sudden, go to a random calculator and punch a price for a ticket. Prices in a marketplace are determined by the interactions between buyers and sellers. So the next time you see a price tag, anything from a Starbucks drink or even a phone plan, remember that number isn't random and it's a conversation and interaction between buyers and sellers. And of course, in my economics class, I go a little bit deeper. I talk about factors that will affect the equilibrium price, like shifts in supply and demand. But that's a conversation for another day. Things like the number of sellers and buyers can affect market price as well. But in general, the idea here in this video is that the market price is driven by conversations between the buyers and the sellers. They will eventually agree on an equilibrium price. If you enjoyed this video, don't forget to like, share, subscribe, and I'll see you in the next video.